Welcome to the National Credit Union Administration's assessment update on the Temporary Corporate Credit Union Stabilization Fund, also known as the Stabilization Fund. Since 2009, NCUA has provided a projected range and periodic updates for Stabilization Fund assessments to improve the transparency of the agency's stabilization actions associated with corporate credit unions. In this video, we'll take a look at the performance of the corporate credit union legacy assets and associated NCUA guaranteed notes, and we'll talk about the projected remaining assessments. NCUA announced the Corporate System Resolution Program in September 2010. As part of the resolution, the agency created the NCUA Guaranteed Note Program, also known as the NGN program. This program provides long-term funding for distressed investment securities or legacy assets from 5 failed corporate credit unions. Between 2010 and 2011, NCUA resecuritized the legacy assets through NGN trusts. The trusts issued approximately $28.3 billion of NGNs, backed by the cash flows from the legacy assets. NCUA guarantees the timely repayment of principal and interest to those who invested in these notes. The NCUA board uses the Stabilization Fund to pay costs associated with stabilizing and resolving the corporate credit union system, allowing these costs to be repaid over the life of the fund. You can learn more about the corporate system resolution costs and NCUA Guarantee Note Program on the NCUA website. For now, let's take a closer look at how the legacy assets that secure the NGN trusts have performed. The legacy assets originally consisted of more than 2,000 investment securities, secured by about 1.6 million residential mortgages, as well as commercial mortgages and other securitized assets. Since 2011, the unpaid principal balance of the legacy assets has decreased by $10.4 billion, from $34.3 billion to $23.9 billion in December 2013. This is the result of principal repayments and realized losses. As the underlying economics have improved, the market price of the legacy assets that collateralize the NGNs has also improved. During this same period, the outstanding balance owed to NGN investors has gone down more than $7 billion to $17.5 billion. This chart shows that the market value of the legacy assets was actually higher than the balance owed to the NGN investors for the first time at the end of 2013. It's important to remember that the legacy assets secure the NGNs. NCUA can't actively manage these funds until investors are paid off. We'll discuss the significance of this in a moment. First, let's take a look at legacy assets losses. An improving economy and housing market, along with various NCUA, broader government, and market participant settlements, have resulted in significantly improved legacy assets performance. To date, realized losses on the legacy assets total $7.5 billion. The pace of realized losses is consistent with the improved total range of losses projected by NCUA. The projected lifetime losses have gone down $3.6 billion, from $16.4 billion to $12.8 billion on the high end of the projected range, and by $1.9 billion, from $13.2 billion to $11.3 billion on the lower side of the range of projected lifetime losses. The NCUA board uses the Stabilization Fund to pay the costs associated with stabilizing and resolving the corporate credit union system, allowing the repayment of costs over the life of the fund. The NCUA board is responsible for determining the amount of any annual Stabilization Fund assessments. The amount of annual assessments is based on a variety of factors, including Stabilization Fund cash needs, projections of losses and cash flows on the legacy assets, performance of the legacy assets, and projections of losses related to disposing of other assets from the failed corporate credit unions. Let's take a closer look at the Stabilization Fund's cash needs. Between 2009 and 2013, credit unions paid 5 Stabilization Fund assessments totaling $4.8 billion. These assessments were necessary to satisfy the Stabilization Fund's cash and contingency liquidity needs. NCUA's borrowing line with the Department of the Treasury is $6 billion, which is shared between the Stabilization Fund and the Share Insurance Fund. NCUA's borrowing against that line peaked in 2012 at $5.1 billion. In 2011 and 2012, the agency also needed to pay out a total of $5.5 billion in medium-term notes. NCUA used the 2013 assessment to partially pay down the balance of the agency's borrowing line with the Department of Treasury, restoring more of the available line of credit. In addition, NCUA must maintain some reserve borrowing authority to cover unexpected liquidity needs. After the 2013 assessment was collected, the agency also had a major success in the legal area, notably the J.P. Morgan settlement, resulting in over $1 billion of additional cash flow. The proceeds from the settlement allowed the agency to further pay down the outstanding Treasury borrowing. It is worth noting that NCUA does not build legal settlements into projections because of the high degree of uncertainty around them. Let's take a closer look at the projections now. As of December 2013, NCUA estimates that the total lifetime legacy assets losses will be between $11.3 and $12.8 billion. However, the total projected cost to credit unions ranges from only $8.4 to $9.8 billion. Right now, projections indicate that costs could be as much as $3 billion lower than losses as the result of legal actions that have benefited the legacy assets or the stabilization fund, as well as the excess spread between the lower NGN funding rate and the yield on the legacy assets. In addition to preventing losses to the credit union system on the order of $40 billion and protecting the credit union system, the corporate resolution and NGN funding mechanism provided a beneficial funding spread and preserved legal upside that saved billions of dollars. After accounting for the $5.6 billion of member capital in the failed corporate credit unions and the $4.8 billion in assessments paid by credit unions to date, the net projected remaining assessments range from negative $600 million to negative $2 billion. This indicates that credit unions could receive a refund in the future. It is important to note that NCUA does not currently have access to funds to pay a refund to credit unions. The underlying legacy assets that secure the NGNs are not available for NCUA to access. This graph shows the latest projections on when the NGN trusts will either pay down or mature. As you can see, the majority of the NGN trusts will mature towards the end of 2020 and beginning of 2021. Some of the early maturities will be used to repay investors and other obligations of the failed corporate credit unions, and then helping to repay the Treasury borrowing line. This graph also illustrates the current projected balance of the underlying legacy assets as the NGNs either pay off or hit their legal maturity date. What's not shown here is the fact that, in some cases, a legal maturity date will result in a balloon payment from NCUA to investors. NCUA cannot actively manage the remaining legacy assets until NGN investors are paid off. Once these investors have been paid in full, the agency will consider all available options to minimize the overall cost to credit unions. Options may include holding the legacy assets to maturity, selling them into the market, or re-securitizing the remaining expected cash flows in a manner similar to the NGN program. It's also important to note that NCUA generates the assessment range each year using projected legacy assets cash flows. Actual performance could vary significantly from the agency's estimates. The projections also assume that NCUA will continue to hold the legacy assets or re-securitize them once NGN investors have been repaid. In this scenario, the Share Insurance Fund would fund or guarantee the assets after the Stabilization Fund closes in 2021. A refund will only be available if there is sufficient equity in the fund at that time to pay a dividend. If the agency uses a different disposition strategy for the legacy assets, like liquidating them at market prices, actual proceeds and any corresponding refund could be lower. In other words, NCUA cannot refund money to credit unions until the agency fully repays NGN investors and pays off the $2.6 billion in remaining outstanding borrowing from the Department of the Treasury. The earliest this is likely to occur is toward the end of 2021, once the last NGNs mature. The good news for credit unions is that there is no Stabilization Fund assessment in 2014. Based on the agency's latest projections, it's very likely there will be no need for future additional assessments, and there's the possibility of a refund once the NGNs are repaid. Visit the NGN performance reports on the NCUA website for updates on these projections. The site will be updated with mid-year numbers by November 2014. Thank you for watching the National Credit Union Administration's Stabilization Fund Assessment Update. If you have questions about the assessment update or information in this video, contact NCUA at eimail@ncua.gov.